Vetri Subramaniam is with us. He's Chief Investment Officer at UTI Asset Management Company. Vetri, good to have you with us here. Thank you very much for your time. Your view has been that maybe some of the valuation excesses have been have worn off. We're not in that zone anymore. But markets have this habit of very quickly. It's not a long drawn out anymore like it used to be, years ago. Corrects very fast and gets out of one zone, gets into another zone very quickly. Where are we now, Vetri, in your opinion? And my question actually is more directed towards mid caps, small caps, which have seen very sharp moves, 20-25% in just 2 months. Go on.
Sure, Prashant. I think you make an interesting point. Without doubt, the cycles are much more sharper in recent times than they have been in the past. And I think it's not just market cycles, it's also economic cycles. They tend to be a lot more abrupt. They tend to, turn direction quite rapidly. But it's all well contained within a range. It's not like volatility is particularly extreme within the markets. You spoke about mid and small caps. Look, again, there could be a 2-month or 3-month period where one segment of the market does particularly better than the other. But again, if I were to just go back to, where I think from a valuation perspective, markets were very rich, which was, all the way back in the fourth quarter of calendar 21, then there's nothing much to distinguish the performance of the Nifty vis-a-vis the Nifty mid-cap index, vis-a-vis the Nifty small-cap index. They're all sort of plus or minus 1 to 3% from October 2021. So, at a different point of time, one segment of the market may have gone faster, one sector of the market may have gone faster or slower, but net-net, the market's made no progress for almost 18 months now. So I wouldn't read too much into those abrupt, turnarounds or cycles.
All right. Well, for now, a lot of stocks in focus. PB Fintech is the one that's surging away, 5% higher on that stock. A lot of these platform companies have come back in a big way, whether it's PB Fintech, Paytm, Nykaa, Delivery, etc. Vetri, hi, good morning. These are some themes that have come back, but these are also themes that have caused investors to burn their fingers quite a bit in the last few years. What do you do now? Do you avoid spaces like this entirely, or do you take the plunge?
Well, two ways to look at this. First of all, as you rightly pointed out, this has been a full cycle, right? These stocks listed, in some cases, they went up, 100% from their IPO prices, and then they promptly sort of gave back, 50, 70, 80% of their gains, and maybe they're just trying to find their feet. Just 2 points I'll make about these businesses. Look, these were always very long growth opportunity businesses. And in an environment where, capital was abundant, the cost of capital was low, people were willing to sort of play up for blue sky scenarios. I think 2 things have changed. One is the cost of capital has gone up quite dramatically, but also to the advantage of some of these incumbents who are reasonably well established in the segments in which they operate. Capital is no longer as abundantly available for anybody to burn. So it's a question of who's able to stabilize their business model faster, prevent the cash burn, and suddenly, for the first time in maybe 6-7 years, there is a constraint which has come upon companies that they can no longer expect capital to be abundantly available and postpone profitability way into the future. So I actually do think for some of these companies, the environment has become slightly more favorable. But again, these are very early days. I think the business models are evolving. Sonia, if I were to look at my own experience, right, we've got some small investments in some of these companies. The way we understood the company before they came for the IPO, the sort of context that we understood when they came with the IPO, and how their business model is evolving today, it's changed quite dramatically in just 2 years. And therefore, I think as investors, for us, it's a question of just sort of getting to understand them better. But these are not really big, high conviction bets at this point of time in the portfolios for the reasons I mentioned.
Okay, all right. Vetri, just hold on to that thought. MRF has become the first Indian company to hit 1 lakh rupees per share. In the last 1 year or so, the stock is up more than 40%. It's had a good run. I think, Sonia, the only point is, what about dividend? The last couple of dividend payouts have been very, very measly. but it's a 1 lakh rupee share. Last 12 months up close to around 40%. Remember, if you look at it on a longer term, in 5 years, it's up still 40% only. So the majority of the move actually has come in the last 1 year or so.
And this year, it also hit a 1 lakh crore market cap. So, you know, there are a lot of milestones coming in for MRF, but there are reasons for it, right? I mean, earnings growth has been very solid for MRF. If you just look at the full year performance, 20% revenue growth is what we've seen. Even in the quarter gone by, I mean, raw material prices have cooled off, demand has picked up. So I guess a lot of tire companies have been doing very well, but MRF, case in point, 1 lakh rupees in terms of the stock price, 1 lakh crore market cap. So in a league of its own, perhaps.
Okay, all right. That's about MRF. But Vetri, you know, the space that's really been calling for attention in the recent past is this renewable energy push. You know, we've heard it in the past, but it seems, you know, the government of India is very, very focused on it. Corporate India as well is very, very focused. Would you play this theme? And if you do, how do you play it? Because some of those stocks in there, they're promised in the past. The Suzlons of the world, the Inox of the world. And they actually, if you look at it in the last 5-10 years, they've been big value destructors. Though in the recent past, they've come back to life. So how do you approach it?
Good question, Nigel. I have too much gray hair on me, and as a result of that, I'm always a bit skeptical when somebody paints a picture of the future without any relationship to valuations, without any context of how regulations might evolve, without any context of how technology might evolve, and without reference to how cash flows and return on capital in the business will evolve. So, I'm not a great fan of getting carried away with those cycles, and I've been long enough in the market to see, some of these stories get very long in the tooth and then, painful periods for a long period of time. I think the biggest challenge that I see in the renewable space in India is a lack of indigenously grown technology. Companies are trying to sort of make acquisitions. They're trying to figure out how to jockey and position for it. But I think we're really sort of on the back foot simply because we didn't have the technology at this point of time. I know government has got a whole raft of schemes they're trying to support through the PLI, through other mechanisms to sort of build the ecosystem here. And I think it's critical for India to pull off and sort of be part of this energy transformation that's likely to happen from carbon to renewable. We need to sort of make sure that we are at the forefront of that and we don't create a new import dependency like we had during the carbon era. But, from a stock market investment point of view, I would say, we are happy to sort of be on the sidelines there. There isn't really enough visibility of how companies are placed in terms of technology and how those businesses themselves might evolve in terms of, cash flow and return on capital.
I just want to, this kind of talks to the kind of market we seem to be in. Pull up a company called Urja. I'm highlighting this only because the stock, it's got large volumes. By the way, it's the third largest volume traded stock on the downside right now. It's down 4%. Sometime back, there was this news that Urja is tied up with a company called Tesla. But this is not the Tesla that is the Tesla. This is not Elon Musk's Tesla. This was, this is a company which operates in the US, but not the Tesla, which, of course, is the one that everyone knows of. The stock did see a very sharp run-up over the last couple of days, and today it is coming off a little bit, 4.5% or so, on very large volumes, mind you, as well. It's a penny stock, 12 rupees or so is where that one is. But just, highlighting that because it's coming up with volumes. Vetri, two, I think, sectors which you have a positive view on. One is pharma and the other is IT services. Both you think are attractively poised from here up?
Yeah, I'd parse that a little bit. I've been wrong about pharma healthcare for a while. It's been a dog even through the last year. But that's an area where incrementally we still think the valuations are supportive. Most of our conversations with companies across a range of businesses suggest that companies are going back to the drawing board in terms of stabilizing the business model rather than sort of, looking to make extravagant growth plans. And that's typically the kind of environment in which you can, get a good margin of safety in terms of purchase and benefit as these companies start to focus on, cash flow and ROC. So it's more of a contrarian position in the pharma healthcare space. IT, I would say, actually, Prashant, is very different, right? Because This was the sector which was the face of the bull market, in October 21. Valuations had reached a level which, honestly, the last time I'd seen those kind of valuations, I had to sort of go back in my own history, a decade or more, to see those kind of valuations. And I think since then, it started to correct quite brutally in terms of valuations. But I think we're now getting to a point where incrementally, we're a lot more positively inclined than negatively inclined. We continue to think that the IT companies remain India's most globally competitive set of companies. And, this whole wave of spending that's happening in terms of businesses enabling themselves with technology, I think the Indian companies are, the best partners they can have in that journey. So that's an area where we now think the valuation excesses have worked off. May still take some time because, the sort of headwinds are a little bit adverse in terms of growth in their main market, which is the US. But as I said, we'd rather look at dips over here as buying opportunities in what are fundamentally fantastic businesses, which, return the bulk of their capital back to shareholders.
Okay, Vetri, thanks a lot for joining us and speaking to CNBC TV18. Appreciate your thoughts.